Yes, we are awaiting the May CPI, and 1% on the headline number, up 1%. That's definitely hotter than the 0.75% we were looking for. The high water mark there was up 1.2 in March, so we're close. And that 1.2 was a 17-year high going back to 2005. Strip out the all-important food and energy, it's still hotter than expectations, up 0.6%. It equals our look in last month, and to put a face on it, the high water mark here was all the way back in April of last year, up 0.9. That was a 4-decade high. But remember, both these are hotter than expected. Year over year, these are the Moneyball numbers. Year over year headline, 8.6, a new cycle high, usurping March, which was 8.5. That was the highest since 1981. Now 8.6 continues to be the highest since 81 because the comp there is 8.9 to 11.8%. And if we look at year over year core, also hotter than expectations, up 6%, following 6.2%. High water mark there, 6.5, and that was in March, and that was the highest since 1982. But remember, even at 6%, coming down from the high water mark of 6.5, that standalone is still the highest since 1982. So these are super stubborn numbers. And our panel, our esteemed panel, has lots of brain power there, and they go in lots of categories, Joe, as to why inflation's here, the all of the above mentioned. I will say that out of all the above, energy. And you know, there's so many comments here about, oh, the administration can only do so much. You know what? We all said that about the Fed. And then there's this thing called forward guidance. So the Fed gets the market to do things long before it takes action by telling them what's in their head, what lies down the road. What was the forward guidance with this administration on energy? We know the answer. Maybe they can't get things to happen faster, but by giving positive forward guidance, by not closing pipelines, by not talking pre-election about how much they don't like fossil fuel, maybe things would have turned out a bit different. Joe? Back to you.
We're going to get right to our panel, but I don't think we've talked to Mike yet. I know I'm taking a risk going from Santelli to Santoli, even for me to get it right. But Mike, the reaction in the market has been swift, stock market.
You nailed it on the name. Yeah, it has. Now, look, as I said earlier, we were bracing for something that had the potential to be an unfriendly number, and we got it. Just for context, you know, the S&P 500, we were at 100% below yesterday's close, was the closing low. It seems like the market wants to test that range. I guess you'd have to say the peak inflation number, it remains plausible, the peak inflation notion, but maybe not persuasive. It's very difficult. And if you think back, May 2022 was when the math was supposed to start working in your favor on the annual number, because May 2021 was actually kind of a hot CPI. So that clearly is not the case. And it basically just means, you know, the Fed sees zero opening to lighten up on its rhetoric and on its plans for half-point increases in the next few months.
All right, go back to you where we started, Jason, and then I want to ask you a theoretical question, but just comment on what you just heard.
Yeah, look, I mean, you look at the monthly number, that's what I'd look at, not the 12 months. I'd look at the core, because there's a lot of volatility and other stuff. That monthly number was an 8% annual rate for core CPI. You can point to some special factors there. Car prices were up again in May. Some of that is supply chains out of China, out of Ukraine. Airfares were up a lot. Some of that is people resuming their travel. But even take all those special factors out, the underlying inflation rate here is quite high, and it's potentially rising. Now, I think the good news is the Fed was behind the curve last year. I think they're there now. They're going to do 50 basis points at the next two meetings. They're not going to let up in September. It's going to take them a while to tackle this, but I think their heads really are in the right place right now, and this number will keep it there.
I thought, Jason, that when I watch the stock market on certain days, I think it's worried about the terminal rate. I don't know how many 50s we do. Do you expect it to, are we undershooting or overshooting for what we think the Fed finally stops? And then the reason I'm asking you that is, if the Fed stopped raising rates, can inflation alone cause a recession? I always think that inflation causes the Fed to shut down business activity with higher interest rates, and Aka Volcker. But if they didn't raise too much, can inflation itself cause consumers just to say, no mas, I'm not going to spend anymore. I can't afford it, so I'm not going to, and everything shuts down. Have we seen that historically?
On your second, for the most part, no, because when prices are rising faster, wages are rising faster, and so people can afford those higher prices. Right now, wages have been behind prices, but at some point, probably, I hope, they'll catch up. On your first question, I think the Fed's raising rates at a decent clip.
What's
I have
the
no
terminal
complaint
rate?
about that. Right, but that's where my complaint is. I think they need to be clearer. My modal expectation is 4% Fed funds rate at the end of 2023. I think they're going to need to do that to deal with this
Doesn't
inflation.
sound very high.
I don't
Doesn't
think the
scare
market's
me.
ready for. I don't think the market. Sorry, at least 4. I don't think the market's ready for it though. They've not priced that in.
Okay, 4. God, at 4, we would have killed for 4 in many periods of the past. They would have been dropping in half to get to 4. It seems like. Where we go, Mona? Or Strain? I guess we should do Strain. Are you going to argue with? I'll let you talk if you're going to argue with Jason.
I'd love to argue with Jason. I think that this is a bad headline number. Inflation is a real problem. If you kind of look under the hood, you see much less of a problem in underlying inflation. The two big things that I've been worried about are shelter inflation and services less energy inflation. Those both look a lot better than the headline look. They look better than the headline core look as well. And that's the real question. The real question is, are we in for a period where we see wages pushing up prices and then prices pushing up wages and then wages pushing up prices? Or are we in for a period where, we have high gas prices, we have an economy where the goods services tilt is starting to normalize, but the Fed can get it under control? This tells me that we're not in for 5 years of misery, that the Fed will be able to get it under control.
Why is that? I don't understand.
Because this tells me that inflation is not accelerating kind of throughout the economy. Again, durable goods inflation has been declining. Shelter inflation has been rising. Services inflation has been rising, but we didn't see a big acceleration in shelter inflation last month. We didn't see a big acceleration in services less energy last month. And so if things are kind of plateauing along those dimensions, then I would expect that higher interest rates will be able to cool off demand, and the kind of wage price spiral that we're all concerned about seems less likely.
Okay, we have time now, Mona, although I'm dying to get to Kathy Bostancic, just so I can say Kathy B. And I'm going to start. That is going to stick, I think, Kathy. But Mona, what do you think?
Yeah, we're kind of in the camp where Michael is falling out on this. I think generally, while headline inflation will continue to cause some concern, it's hard to handicap how the war in Russia will play out. We're seeing China come back online. All of those factors will lead to higher demand for energy, higher food prices potentially. But if you look at the core inflation, services and shelter and rent are about a third of CPI. And what we're seeing in mortgage prices, moving higher, that is putting some downward pressure on housing. It takes a little bit of time for that to play out into CPI, but over time, that should be a supportive factor for lower core CPI. Also, what we're seeing in terms of some of the headlines around the tech layoffs, for example, over time, that will play into lower wages as well. And so we think generally some of the components of core CPI should trend better. Keep in mind the Fed's preferred metric is core PCE. Raising rates can't really impact WTI or energy and food prices all that much. It's really their focus should be on bringing down the core, and hopefully over time that's a trend we'll see.
Kathy, I practice too. It's kind of a waste if I start calling you Kathy B after practicing how to actually say your last. But I'm going to do it anyway. What do you think, Kath?
Well, I think that this is still a concerning read for the Federal Reserve. I do agree with Mona's points. Our own view is that inflation will trend lower as economic activity slows and interest rates start to bite. But when I look at, owner's equivalent rent, so rental prices, they actually did pick up. They were up 0.6. It had been running 0.5. So that's a hot number. Core service prices are picking up. Core cooling quite as quickly as some people expected. And let's keep in mind, remember in March, people were cheering that, oh, we reached the peak in inflation. Well, we just found out today we didn't. We're higher today, right? Year on year, 8.6%. So gasoline prices are going to stay high. So I do agree eventually this is going to cool, and we should see cooling along with wage growth as well. But I think it's going to take a bit more effort by the Federal Reserve and time. And I would think that 50 basis points, next week, July, and this puts 50 basis points on the table for September too, I believe.
I think so too.
Yeah,
I mean, look at some of these numbers that go through this. You're talking about medical costs going up. You're talking about airline fares going up. You're talking about rent or shelter costs. So on a year-over-year basis, up 5.5%. I'm reading through.
You have glasses on. Have you ever done this before? Is this a new? This is.
I can't see.
On air.
I can't see. I'm trying to read tiny little graphs.
Does it bother you that at my age I still have no glasses? Or?
You've got one weird contact. I know too much about you. No, I think Kathy's take is a very smart one. I think everybody's right. There's something to take out of each of these things. But I have to say I'm a little surprised by how strong some of these numbers are that we expected to drop off. Furniture prices are still going up. And that's where we thought we'd be seeing some big discounts. Maybe that comes up in the next month. But these things are not cooling off yet. And it's going to be hard for the Fed to do that. And if you look at what's been happening to the 10-year, I mean, that's an issue, too. How much the 10-year has gone up while we've been talking about it.
Rick, I was going to come to you and do you think 4% will do it, Rick? That's what scares me is that and wages do continue to go up. And then I start thinking wage price stuff. And
wait a second, I take it back. The 10-year came back down. It's below 3%. What explains that?
What's the terminal rate? And that's a terminal rate in your view this cycle, Rick?
It's kind of like a camel here. See, right now, we traded over 290 briefly in 2-year note yields. And you're exactly right, Becky. That's what I've been trying to wave at the camera for. 10-year note yields are going down. 10s to 2s has flattened a dozen basis points, which means that we're guns hot for the Fed. But I think that hump in the middle, answer your question, Joe, the terminal rate is going to be somewhere between a little higher than the 2-year rate and probably a little bit less than where the 10-year ends up, meaning that even though 10-year note rates have had a 320 intraday high, and maybe we'll get a higher intraday high, I suspect we will, I do think that the terminal rate we end up with is going to be somewhere between 2 3/4 and 3.25%, way below that 4% I think that Jason was looking at. I do think inflation in many areas and commodity prices in many sectors is going to come down. But I think that some of the stubborn issues, energy, food, labor, especially the first and third, energy and labor, they're not going to be. And in terms of rents, I know Becky was trying to comb through the numbers. Rents are now, the average rent across the country is now over $2,000. Food's over 10% higher. These numbers aren't going to go away, even though some numbers will. And when I do these CPIs and PPIs every month, we're going to see some positive movement. The problem is it's not going to flow equally to everybody that needs to spend discretionary money and those, of course, that won't have the luxury to call things that are stubbornly high discretionary purchases.
Who wants in? Anyone have?
Joe, I'm a little more worried than Jason. To answer your question to him, I'm a little more worried than Jason about inflation slowing the economy on its own. If you look at what's happening, most workers are seeing their real wages decline, their inflation-adjusted wages decline. Households are seeing real incomes decline. We just saw this morning that overall household net worth edged down a little bit for the first time in a couple of years. And when people have less money, when people have less purchasing power, they buy less stuff. If you look at forward-looking surveys, households are telegraphing this. They're saying they're going to pull back. Consumer sentiment is lower now than it was during the lockdowns, which is just a shocking fact. And so I am worried about the consumer saying, hey, enough is enough. Maybe that happens this spring. Maybe it happens after summer vacation season. But at some point, I think consumers have to pull back.
Okay, the mic is open. We don't actually have to pass it.
Yeah, I mean, consumers,
Go ahead.
Look, consumers turned really pessimistic starting in August of last year. They keep spending like crazy. Spending for this quarter is tracking at about a 4% annual rate. That's twice what it normally is. we gave them so much money that there's still quite a lot there if they want to continue spending out. So I would, the American consumer may be gloomy, but they're booking an awful lot of airplane flights.
But Jason, I think probably Janet Yellen said some of those things to Andrew yesterday, too. I think what's so interesting about that, they feel a lot less wealthy. They don't have stimulus money coming in like they did last time. I was just looking through some of the food costs that are up like 9.5% or something year over year. And when you start realizing that you're going to be paying more and more and you're not going to have the same amount that's coming in, and when inflation is outpacing any pay increases, you can understand why they feel less wealthy, even if it hasn't shown up in their pocketbooks right now. They know it's going to hit them.
Oh, look. Real wages are falling at the fastest pace in 40 years. I'm not trying to say things are good.
Yeah.
I'm just trying to say I am more worried about excess demand in the economy, even over the next 6 months, than I am about the opposite, which means I think more persistent inflation, the Fed needing to stay at it for longer than Rick seems to think they're going to stay at it, because this inflation is going to be more stubborn. I don't think it's going to solve itself.
Jason, but then how do you deal with trying to tamp demand on one end, and then you're going to be seeing these headlines, you're seeing stories. I was just yesterday on NBC News, actually, about families that are now driving less. They're literally trying to, do, by the way, it could be like a return to, instead of return to work, return to working from home, so that they can avoid actually paying gas. But so I think you're going to see this sort of division, no? And then what do you do about it?
Look, right now, if you tamp down on the economy, you're going to slow price growth and you're going to slow wage growth. I don't have any obvious answer for which one of those slows more than the other. Right now, we're in the bad situation where we have a lot more price inflation than wage inflation. Maybe you slow the economy and you slow prices more than wages. I just don't know which of those slows more. So, you may be helping people, but we're not in a sustainable place right now.
I think wages slow more. Nominal wage growth has been trending down if you look over the last few months, as opposed to looking year over year, which I think is the better way to look at it. And the Fed's going to have a hard time controlling global energy prices and global commodities prices that are pushing up gas prices and grocery bills. And so that, I think, is going to add additional pressure on consumers to pull back as the purchasing power of their wages erodes even more.
Just to add on a bit, I do think that we have enough momentum, and as was mentioned earlier, we have enough money that's been saved, right, for savings during the pandemic, and the labor market's still really hot. It's not just inflation, labor market's hot, and consumer spending, we agree, it actually can be close to 5% annualized in the second quarter. I think we kind of maintain and we avoid any type of hard landing for the consumer and the economy through, let's say, through this year, at least through the fall. But come next year, that's where we're more concerned, right? We are in an unsustainable place here. Inflation has to cool, and for that to happen, the Federal Reserve has to stay aggressive. And to tamp down on demand, it's really hard to get that just right. So our baseline is, yes, they could pull this off, but certainly the risks are rising that we get a harder landing for 2023. Not this year, maybe towards the end of the year, but it's more 2023 that we've been more concerned about.
I agree exactly on that timing.
Okay.
Sorry.
I just add quickly that what we're seeing in yields is interesting, too, with the 2-year starting to spike here towards 290 and the 10-year actually dropping. We're seeing a flattening of the yield curve again. Markets are certainly pricing in more slowing growth, potentially recession risk. We're not getting the inversion yet, but perhaps that comes back onto the table as the Fed clearly has to continue here. I think June and July were in the cards already, but now September, as we're seeing probabilities rise there as well. And that could really push the inversion yield curve narrative over the next few months, which also then kind of keeps the whole value versus growth regime on the table again. It's hard to get growth to come back to the table if we're starting to see some of those yields move higher.
Great, Mona, thanks. And thanks to Jason, Michael, as well, Kathy, Rick, and Mike. And that'll do it. Andrew.
Thanks, Joe. I want to get straight out to the CNBC Bureau in San Francisco, where Jim Cramer is this morning, to get his take on the hotter than expected inflation number. But let me ask you this, Jim. Do you think the Fed has to go 75 basis points? And what does that do to the credibility of Jay Powell if they do?
Well, I want to, and I've been saying this, want him to go 100. Just get it over with, 100, to see if things slow down. I think that Jay Powell's beginning to get this reputation that he is a do-nothing guy. And what I really think he's trying to do is be measured enough to be able to bring things down. But measure's not going to cut it anymore. If he does something that really makes people realize, holy cow, there's going to be recession, we cut back, there's more of a chance to be able to get through this. I think now we all just have to feel that there is going to be a recession of sorts. But, Andrew, the one thing that keeps coming up is the consumer is not going to be the source of it. We talk a lot about the consumer looking at the pump and looking at food, but the consumer's balance sheet is great. I'm not whistling past the graveyard. I'm just saying that versus 2008. I think we have to do everything versus 2008. Because I think 2008 was something that really drove the stock market down. And this is going to take a lot of the parts of the market down, but not all of the parts of the market down.
100 basis points brings the market to where?
The market would go higher. We give the, well, not the NASDAQ. If your company's losing money, it doesn't matter. You're not going to get more money. And those companies are going to go under. And those companies are going to have big layoffs. I think out here, by the way, there's a surfeit of engineers. I mean, think about it. That was the height of the problem. And the market is creating a glut of engineers. Now, we have gluts of goods. We're going to have gluts of cars because the semiconductors are coming through. We don't have gluts of housing yet, but I think 5.5% to 6% mortgage is going to create that. So I'm listening to everybody, and I keep coming back to the same thing, which is you get gasoline down, and we have nothing to talk about 6 months from now. That's got to come down. And that can only come down if President Biden decides that he wants to speak to the largest producer of oil in the country, which happens to be in Texas. But that would put him with the fossil fuel people. And he doesn't want to do that because his base doesn't want him to sit down with Mike Wirth from Chevron.
I just want to go back to this. 100 basis points, do you think the market rallies?
Yeah, absolutely. Everyone's just waiting for Jay Powell to show his teeth. And then they realize, listen, the Fed is not going to let this get any more out of control. And then the market rallies.
And what handicap the fact that he does that at this point?
I still think he's incrementalist. I just think he feels that would just cause that could be too much like December of 2018. But everybody's in better shape than 2018. So it's worth doing. It's just he's got to get ahead of all the people who sit here and talk, who are expecting that they need 75. And they would all be appeased. All the bears would be appeased. Then it'd be over. It'd be over. Because he'd done something that just says, you know what, I know you guys all think that I'm asleep at the wheel. Here's 100. Go knock yourselves out. Go do what you have to do. But now we're going to be able to slow down and see what happens. Instead, it's going to be 50, and then we'll have the same panel, and we'll say you didn't do much. Then another 50, and the panel will come on and say you didn't do much. You know what? If he does 100, then what people say is, wow, hold it just a second, he's way ahead of us. Got to get the naysayers and the price target cutters out of the picture.
Jim Cramer, never one to hold back. Appreciate it, and appreciate all you have done this awesome week of coverage out there in the Valley. It has
very
been
gloomy.
Fantastic.
Very gloomy.
Jim, before you run away, very quickly, if he were to do that, 100 basis points, what would the market's reaction be, at least in the
initially
in the
down
near
and then
term?
up, because people would say, you know what? Maybe we're done. Maybe the 20-year is not going to go to 4.5%. Because we're going to have a guy at the Fed who just says, listen, we're going to whip inflation now. We're going to kill it. And that's all there is to it. So you go about your business, but it will be less. There'll be less inflation at this time next year.
Jim, thank you. We will see you in just a few minutes. In the meantime, let's bring in Mohamed El-Erian and get a little bit more. Oh, by the way, Jim has the CEOs of AMD and CyberArk coming up a little later today. We'll be watching that, too. Let's bring in right now Mohamed El-Erian, Allianz and Gramercy advisor and president of Queen's College, Cambridge. Mohamed, what do you think? If he were to do that, if Jay Powell were to go ahead and move 100 basis points, kind of shock and awe, I do think we've kind of gotten to the point where you can say you're going to tamp down inflation and that is priority number one, but people may not believe it until you actually, what was the Hank Paulson phrase? You know, you've got a bazooka, you got to pull it out and show them.
Yeah, I mean, he needs to regain control of the inflation narrative. He had lost control a little bit. Now he's losing total control. So he's got to do something. You've heard me say over and over again, the first step should be explaining why the inflation forecasts are so wrong for so long. And second, I agree with Jim. He's got to move, because if he doesn't, he's going to be chasing the market and he's not going to get there.
So if that is what we've already seen, another 383 points this morning on the Dow futures, even after the 600 plus points that we lost yesterday on the expectation that this would be a hotter number, what happens if he raises 100 basis points right out of the gun, surprises people? Like, how far down do we go before things stabilize?
So remember, you've heard me say we are pricing 3 different risks. Interest rate risk, that's what you're seeing right now in the market. Second is credit or recession risk. We haven't fully priced that in. And then, God help us, we don't have to price in liquidity risk. So what happens? I think you get rid of the interest rate inflation risk by hiking aggressively and giving a clear message, but you're going to have to deal with the credit risk. So my gut says Jim is right, but it's going to be a bit of a V. We'll come down first before we recover.
Okay, the numbers way hotter than expected, and let's just talk through some of those issues. We thought that we were going to be looking at headline numbers going up. We know food and energy prices are going up, but that was up by significantly more than anticipated, up 1% versus up 0.7%. But then it was even the core, without those things, was still hotter than had been expected. We're talking about numbers up 0.6% versus up 0.5%. On a year-over-year basis, the core itself up by 6%. That's huge.
Yeah, and I was with you a few days ago, and I said I'm baffled by people who are confidently saying inflation has peaked. Becky, if you take the first 10 days of June, and if they are what prevails for the whole month, the next measures are going to be even higher. So inflation has not peaked. We need something to happen to stop this inflationary process broadening throughout the economy and building its own momentum.
We also had, you also said the other day that the American Rescue Plan and Build Back Better wouldn't have been a problem. We even just had Jason Furman acknowledge it was a problem, Mohammed. So I don't know what it'll take to get you to backtrack on.
Joe, I said it's the 5th reason. The Fed is first, the war is second, the energy transition is third, and then the supply side, the supply chain disruptions.
Okay. We've argued Keynesian stuff for years, Mohammed. We've argued about that more than about the Mets over the last 15 years.
Well, you don't even talk to me about the Mets when they're in first place and when the Reds are
I just said it. The Reds have been doing much better since they started out 3-30.
I've been waiting this whole season. No, the Reds are coming back. They're now playing. They've got a 300 average.
I'm going to ruin it right now. I'm predicting a Subway World Series.
Don't, Joe. Please don't.
I'm predicting that.
No, please. We're going to collapse as usual.
Mohammed, you got any timing? I know it's really tricky to call direction of the market alone, but timing on this, I have heard some people talk about how they think this summer you're going to be testing these new lows. How maybe as you get into the fall, you see things really drop before it picks back up by the end of the year. Does that sound like a fair assessment, or is there too much to really figure out on a timing front here?
It's hard because there's still a lot of liquidity sloshing around. I'd rather see the restoration of value process happen quickly because there's starting to be really attractive opportunities, but there's this liquidity risk overhanging the market.
Where are the really attractive possibilities that you're seeing?
In tech. I mean, there are some really appealing opportunities in tech, but I keep on stressing we haven't dealt with the liquidity risk yet, and I'm hoping we don't have to because that one would be more painful than what we've seen already.
How do we avoid dealing with it?
By the Fed regaining control and not causing an excessive tightening of financial conditions that becomes a problem in itself. And Becky, there's a lot riding on the Fed regaining control of the inflation narrative, not just for the markets, for the economy, for social stability, for politics. This is an important moment.
You think they can regain it just on the core, and that would be enough, that people are going to be able to look past the headline inflation, the food, the gas prices that they pay on a daily basis?
Economically, yes. Politically, no. You know, we tend to talk about core. We tend to make adjustments. For the person in the street, it's all about headline. Yeah. And that is what plays out in the politics. But for the economists and for the market, yeah, they can regain control.
Okay. Mohammed, thank you for being with us. It is really good to see you as always, and thanks for the quick analysis on
Subway
these numbers.
Series coming up. Subway Series.
Haunting him.
Joe,
coming
no,
up.
Please no, Joe.
Could happen. Really could. He should not be predicting that. He's doing that so the Mets don't collapse. He's saying the Mets will collapse because it's trending. Final check on the markets. Maybe not. Can we just go into the weekend? No, we're down 461 now after 600 yesterday on the Dow. That's 1,000 in 2 days. Nothing looks real good on that screen. Make sure you join us next week. We'll see you back here. Sorkin, Squawk on the Street is next.
See you on the desk.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber. No moderation in May CPI as headline hits 1%. That's above estimates. Year on year, 8.6, a new cycle high. Even core stays steady from last month's 0.6. Futures obviously adding to Thursday's late day swoon, and we are watching the curve today. We will begin with May's hotter than expected data. Jim, you just talked about it with Becky. I was looking through every major component. Nothing fell. Not apparel, month on month, not used cars, nothing.
Well, I think that what's a shame about that number is that apparel's fallen big since then. Used cars have fallen very big since then. We obviously are now stalled in the housing market because rates have gone so high, and the lock-ins are from 2 months ago. So this number is rearview mirror. At the same time, I think that the number is scaring people. And if the Fed acted right now with a big jolt, I think that what would happen is people would say, you know what, it's going to peak and the Fed is in charge and I'm less concerned and we can move on. But right now is a critical moment. You can really knock inflation out right here, except for gasoline. And that's up to the president. The president can negotiate a lower price, but the president has to give in to what the oil companies want. So I'm very bearish about right now, obviously, because people don't realize that there are a lot of components that will be much better. Food will not be much better, but that's obviously transient to some, not to me. And gasoline will be worse. And you have to start going back to when there's been big gasoline step functions up. David, you know that gasoline's very hard to get down unless we get about a couple million barrels more per day. And nobody sees that coming.
Yeah, well, and getting 1 million barrels more a day is going to take a while regardless, even. But to your point, you believe that it would help bring down the price near term in terms of at least changing the curve a bit. Refining capacity, though, is another issue. We've talked about it, Jim. That's not going anywhere either.
No, and those companies are making fortunes, and they should be careful. They should be careful because they're going to be vulnerable to the congressional investigation that we know is going to happen, David, when we see their quarters. But it should not extend to the companies like the company that you're looking at, which is Exxon. But we do know that the refinery margins are way too high and will draw a lot of scrutiny.
Yeah, no doubt. And listen, you've been saying it over and over again that there needs to be a conversation. It's not completely clear to me that there is no contact whatsoever between these companies and the administration, Jim, but certainly, well, listen, I'd encourage them to just watch our documentary on June 22nd, because you're going to hear from Darren Woods, who leads the most important oil company in the country and arguably in the world, other than perhaps Saudi Aramco. You want to, no dialogue? Listen to what he has to say, because it will give you great insight into how they view the transition, how they view their current place in the market right now. As well, Jim, and maybe that's all it's going to come to. But perhaps at some point, more of a back and forth conversation between the leaders of these organizations will occur. But again, it's not as though you can just hit a switch. You know that you can't.
No. And Carl, I'd point out that you have to start going back and looking at the big jumps in oil. The jumps in oil in the 70s, the jumps in oil in the early 80s. And what happens is people ultimately get used to it. People buy, I'm sure Phil LaBelta with this, they go electric. We can't meet the demand for electric. They'll start working even more at home. There are ways to be able to get around this, but it's going to take time. And in the interim, Jay Powell should be having a 9 o'clock press conference, 9:10, and saying, look, we've had enough. We're moving right now. We're moving 100. He will not want to do that because he's a little incrementalist, and also because I'm not sure he wants to do shock and awe. But, Carl, right now, the American people want to know that the Fed has got this moderate and it's got it under control, and they'll feel better. There'll be less right now worry about recession than the idea that the Fed is not doing enough.
Yeah. Well, we'll have at least the National Economic Council Director Brian Deese in a few moments talk about what policy moves can be made. As for the markets, Jim, Fed Fund futures now pricing in a half point in June, 1 in July, 1 in September. And we should obviously remind viewers it's a global picture. We're obviously watching Italian debt today, Greek debt. Rate moves of this sort in rates does open the possibility, Jim, of, I don't know, ghosts of former sovereign debt crises.
Well, look, I think that fortunately central bankers know what happened in 2008, and I don't think they're going to repeat it. I want to give them. I really do think they can do a good job there. Look, they're just shocked, but you have to get rid of the mentality. I mean, out here it's incredible, and I'm not going to mince words about it. The person that you hear the most about out here is Jamie Dimon and his hurricane comment. There were a lot of people after they heard it said, you know what, we got to reconsider our hiring. Maybe we have to say, look, someone who is that knowledgeable, sees something coming, we have to fire. That was a very important comment. David, I know it sounds hard to believe, and I'm not picking on Jamie Dimon, but his reversal reverberates everywhere.
I know. I'm not quite sure what to do with that. I've heard some things that point to potentially the reason for his reversal, but I haven't confirmed that they are the case. If they were true, though, it wouldn't be based on what people thought. I have to say that, Jim. I know that sounds odd, and it's probably
is it too late? Is it too late for him to clarify
saying something?
Which week was right? The week where he was sanguine?
That is the question. That is, why not have already taken some opportunity to clarify to a certain extent what it was or why there was that change in that 5-day period? It's very interesting that people took it so seriously, because we do know Jamie, can tend to talk off the cuff, from the heart, so to speak. It's what makes him a good interview. And so, you could imagine that it wasn't necessarily something that had been thought through in great detail, but I just don't know. And I don't know if you've gotten insight. I haven't spoken to him directly in any way, shape, or form. I've heard a couple of things that I probably should make calls on. I've been busy, working on this other thing. But
I'm sorry,
but Jim, it's interesting that has been sort of driving the dialogue. Is interesting to me, even out there.
David, it really. I was at a dinner last night, and all anyone could talk about was which Jamie is right. Because if it's Jamie of the hurricane, we got to fire. And they weren't talking about Jay Powell; they were talking about Jamie. And Carl, I think he really didn't understand the power of his words. What he should do is come out and say, "Listen, let me clarify." If he doesn't, then what happens is he did something bad for his bank and for the economy. And maybe that's what he wanted to do, but it sure seems like a strange thing for a banker to do.
Jim, how are you characterizing the market response this morning? What levels are important to hold? Mark Newton, a well-known technician, says that even after yesterday's sell-off, as long as we hold, say, the high 3800s, that May low is still viable.
Well, I think there's a bifurcation in this market that's extraordinary. I mean, you are seeing stocks like, let's pick on some ones that are doing well. Airbnb, DoorDash. These stocks go down 9-10%. DocuSign goes down 20%. We have two markets. We have the markets that was created by 2019 going forward, and we're just taking those apart every single day. And then we have other parts led by oil. Banks go down, they drift down. Healthcare's okay. David, look, I think what people are saying is, do you remember in 2000 when they decided to take apart everything NASDAQ, leading with Cisco and Intel, but that Bristol Myers held up? We're just doing a 2000 playbook. I think we've got to dust it off.
Now, I do hear those comparisons to 2000 often as well. I mean, we've looked at different parts of our market now in terms of the speculative excess, whether it's SPACs or perhaps things related to crypto. But the damage being done to some of these companies is not dissimilar. You're right. That said, Jim, many of the companies from the dot-com boom, of course, never saw a dime of profit, never had the prospect of it, and we're down 99.9% because certainly the business models that have been funded by that huge amount of capital went bust. That's not going to happen here. But I keep waiting, and I know you do, for when the bottom is put in terms of, all right, this is a multiple that makes sense based on the future prospects for this company, and we've already discounted the growth rate, and we've taken the multiple way down. I don't know. I hear more often now from the hedge fund cohort, the people I still speak to in that world, that they just can't figure it out, that it's not an investing environment that they can figure out at this point. A few weeks ago, I mentioned that Coatue, the very large hedge fund, has had a great track record of success. Philippe Lafon, who runs it, was 80% cash. 80%. But maybe that was the right move in a market like this, Jim. Simply saying, I don't get it. I can't figure it out. I'm too confused, and I'm going to step aside for a bit.
Well, we were earlier, there was Mohamed Al-Arab was talking about the credit risk. I'll tell you where it is. It's venture capital. A lot of these companies need a much better market. A lot of venture capitalists, Dave, the tail of this era may be Tiger Global, which is you're the only one really taking it seriously in terms of the damage it's done. But there are a lot of venture capitalists I've spoken to which just say, look, if you really market where these companies are, you would find that Tiger Global and its ilk jacked up the prices, went to the bankers, said, here's what the prices are. And the prices now of the companies that are left are a fraction of what people thought they were. So you get this situation, Carl, where people just say, look, the IPO market is shut. There are a lot of companies like DocuSign. If you go in the DocuSign quarter, again, the management acts like it was a great quarter. Management just says, hey, listen, it's never been better. And we added and they always have something new that they added. And Carl, when you listen to the call, you say, hey, guys, your stock is down 25%. Address it. Address what's happening. Please, Dan Springer, address what's happening. And Dan Springer will say our business has never been better. We have a new feature that coordinates with banks. And someone has to say at that moment, what the heck are you smoking, partner? You have just cost people a fortune. Why don't you just say, listen, we know that the stock's bad, and we got to figure out what the hell to do. And you know who did that? Dara. He absolutely had one of these moments where he said, you know what, I have got to come to grips with the fact that we're not doing well. And he talked about it. But the people on these calls like DocuSign, you would think they think, hey, listen, it doesn't matter what happens to our stock. We're just going to keep doing our job. Carl, it's not like that. There are people who own the stock, and they're getting crushed. And Dan Springer's going to tell a story as if it's not happening, as I think Stitch Fitch would. Rent the runway. What a story. Carl, it's got to end. It's got to end. They have to say, you know what? We came public at a great moment, and it's really amazing, but we are not doing what you thought we would do.
Yeah, ton of bearish calls today. Wedbush calls DocuSign a debacle. Evercore cuts to inline. B of A cuts to neutral, goes from 120 down to 72. As for Uber, Jim, Dara did talk to you about not only how early, I guess, he was in getting cost discipline baked into the model, but also the idea that somehow Uber's recession-proof. Take a listen.
We're not rooting for a recession, right? The business is growing at really high rates right now. We're growing top line and bottom line. And I think what makes Uber different is that we're a truly durable company. We are recession resistant in that we don't have big fixed costs, and our cost of supply essentially adjusts up and down.
Today, Jim, we're going to talk about the Goldman downgrade of Netflix, eBay, Roblox down to sell, but their buy ideas remain Meta, Google, Amazon, and Uber.
Well, there is a circling the wagons among who's going to get advertising. The advertising is going to go far more to the bigger guys and cut off the oxygen of the little ones. If people want to know if the Dan Springer, so I don't want to pick on him too much, which is exactly, of course, what I'm doing. But if you read Dara's letter, Dara's letter just said, okay, listen, everything's different, everything, and we got to change. And we don't want our stock lower. We want our shareholders to be happier. To do that, we've got to do a lot of things. There are going to be more drivers because there will be a slowdown. But David, Dara's letter is what? Yeah. What's a No, that was a letter that addressed what's happening.
You agreed. Fine.
Oh, okay.
But when it comes to these stocks, and you're talking about 2000, we're showing one side of it. You got to show the other side. It's just a big round trip. They're all big round trips. We sat there talking about how times were great, how growth was great. The multiples went skyrocketing. The Fed, obviously, balance sheet went to $9 trillion. Show the whole thing. DocuSign, Zoom,
I'll
Uber.
show the whole thing. Look, I want me to put the
same.
chart. Give me the chart of DocuSign, please. Hey, I'm calling it up, David. Now, what about? You're absolutely right. It's just a giant bump. But the question is not the multiple. It's what are these companies? Is DocuSign worth $17 billion or is it worth $7 billion? And there are no takeovers. Like, no one. You don't hear Jamie Dimon saying, this is my time to buy DocuSign. You just hear him talking about Reuben Hurricane Carter or whatever. Do you think he knows who Reuben Hurricane Carter was?
Yes, of course he does. Of course he does.
Do you think he's out of touch?
He's an old guy like us. He knows. He knows who he is. Yeah.
Yeah.
Play the Dylan song.
All right.
I don't know. All right.
Guys, coming up, we're gonna.
You think he knows who Wilbur Warren Monroe was?
I don't know.
We'll talk more about Netflix and this Goldman slapping a sell rating on the stock in a moment. Shares down 5% pre-market. We'll get more to Stitch Fix, Disney, Tesla, and all the comments in the past 24 hours from Druckenmiller, Einhorn, Yellen, and more. Don't go away.